What's going on, guys? Welcome back to the channel. In this video here, we're going to be doing a stock analysis on Shopify. The company's stock has been taking a nosedive in the last several months, I think starting from November. So I want to dig into the fundamentals, the financials, and determine what is a fair price to pay for this business. So without further ado, let's jump into Shopify. We're going to load this up into the stock research tool here, and we'll pull up the company metrics. And what I like to do here, folks, if you're new to the channel, is I like to look at the 5-year averages and compare them to the trailing 12 months to determine where this company's essentially heading. So with our PE ratio, we had a huge number here at 200, wow, and now we are sitting at 30. So these are some great improvements to see. Huge EPS growth over our 5-year average, huge return on equity increase from our 5-year average. 5-year average was sitting at 3.99%. Now we're sitting at 27. That's phenomenal. Huge increase in profit margin from 10% up to 63. Guys, first 4 categories looking really good for Shopify. Revenue sitting at $4 billion with net income at $2.9 billion, $500,000 free cash flow, and our average is 159 million in free cash flow. Guys, I'm very impressed with this company so far. They are crushing it in a lot of categories. Return on invested capital, though, is somewhat low, only at 2%. I mean, it's better than the negative number that we currently have in our 5-year average. Huge Allman Z-score at 26, which we want this to be over 3. And our Piotrowski score is sitting at 3. Interesting. That's a very low number. That's not great. We want this number to be between 8 and 9. 9 is the highest number you could possibly achieve, and we don't have that. So just inspecting this little snapshot here of the business, we're seeing a lot of jumps in numbers and jumps in the right spots. We have a decreasing PE ratio, huge EPS growth, return on equity, and profit margin. So far, I'm liking the company. However, this Piotrowski score, it's really low. So I'm wondering, we'll have to dig into that and see what's that all about. So with that out of the way, let's jump into the financial evaluations category on the app here. And this will help us grab a more detailed understanding of where this company is currently graded per se. So pulling this up here, we're scoring this 7 out of 10, and we're losing points in 3 key categories here. So with a 5-year average PE ratio, as we expressed, it was at 200. Return on equity average was 3.99%, and return on and the 5-year return on invested capital average is at -2. Granted, from our company metrics category, these are all areas that they're improving, so that is really great to see. However, where the positives come in as well, just currently where the company's standing, our current ratio is sitting at 12.15. Yeah, this 12.15 number is absolutely huge. Like that, we want this number to be over 1.5. So that's amazing that they have all those assets on hand because they can cover all their liabilities. So that's great to see. EPS growth is up, as we expressed in the company metrics category. Incredible growth. Debt to equity, we're sitting at 10.40. Now we want this number to be under 50% because that means the company is growing through equity and not through debt, which is phenomenal. And I apologize, maybe I should have announced this probably earlier on in the video, that if I sound a little bit, not as enthusiastic as my other videos, is because I'm pretty sure I've been working like a 20-hour shift or something, but I'm dedicated to try to get these videos to you out on time. So that's why I sound like this and look like this. This is so our share dilution, we're sitting at -4% over the last 5 years. That's phenomenal numbers, folks. We want the company to either buying back shares, so you own more of the business, or keeping the share count the same. And we don't want them to be adding more shares, and Shopify is not doing that, which is phenomenal. So a -4% or decrease is great. Hopefully they do it. However, the only time this would not make sense is if the company's stock is overvalued. And if we just zoom out for a quick second here, we did get to a high of $1,700. Now this is on the U.S. exchange, because this is a Canadian company. So fellow Canadians out there, um, so we got up to $1,700 at one point, and now we're pretty much in half, or just less than half. So we don't want them buying back the stock if it is overpriced. That's one thing to just keep in mind, folks. Net income growth, high. 5-year free cash flow growth, also improving as well. And then as well as our revenue growth, huge numbers, 64% revenue growth. So our return on invested capital, as I said, 5-year PE ratio, and return on equity, those are the points that are going to be taken away from this business. However, they are progressing in the right areas from the trailing 12 months. Time will only tell if those numbers improve over time. Return on invested capital, I would love to see that number 10% or higher, hopefully within the next few years, but obviously that's just going to just come as this company gets more mature. Now, the PE ratio is currently sitting at 30, which is great because this company's stock price, as I said earlier on in the video, has been taking a nosedive. So now this might be a great opportunity for us to scoop in and buy it if it makes sense. So let's jump into a price analysis to determine what a fair price to pay for this business would be. And folks, if you are enjoying the video so far, please consider subscribing. It makes me feel warm and fuzzy inside and helps me get a good night's sleep because I am absolutely exhausted. Anyways, let's jump into a financial. Oh my God, what are we doing? We're doing a price analysis. Let's jump into a price analysis and determine what a fair price to pay for this business would be. So we're going to do 3 estimates here: conservative, moderate, and aggressive. And I'm going to just plop in some numbers here, staying conservative as always, because we want to make sure we have a decent margin of safety, folks. That is the most imperative thing. So let me just do these numbers real quick and we'll touch base in just a quick second. All right, folks, so I put my numbers in. Now I want to just go through these numbers quick to show you what I've done. So with the revenue growth, I've gone with a super conservative estimate. Now granted, we've seen some major revenue growths in the past, with from 80, 64, and 57. However, I want to be conservative as possible, so I pretty much just chop those numbers in half. And once we plug in these numbers, I'll play around with it afterwards to see what it would take to make sense, because I have a funny feeling putting these numbers in might show the company being overvalued. However, we always want to be conservative to give us that proper margin of safety. Profit margin, what I did was I want to stick around the 5-year number here, so that's why I went 8, 9, and 9.5. Free cash flow number, same thing. I wanted to stick around that 5-year number. And price to free cash flow, I want this number to be under 20. So with conservative estimates being 14, 16, and 18, I felt like that made the most amount of sense. Now our PE ratio, I'm going to go 14, 18, and 20. Because we want to keep the number underneath 22.5, and as well as we are doing a 10-year evaluation because I believe Shopify will be here in the next 10 years, and they'll probably be bigger and larger company, as well as more businesses become online or progress to more online shopping, they are going to be a major player in that market. So without further ado, let's put in our desired return. I'm going to put it at 13, as we always do. And yeah, grossly overpriced. And unfortunately, we are sitting at an average calculation here at $260. On the high side, 362, low side, 157, and yeah, 264 on the moderate side. Now, granted, if I up these revenue growth numbers to, let's say, 30, and we'll go 35 and 40. All right, so not as much a margin of safety. However, we are hitting that 787 average calculation, and our moderate number is 748 with an aggressive number at 1200. So here's something to keep in mind here, folks. If you think in the next 10 years they can grow 30%, 35 and 40%, this potentially would be a buy all day based off these numerics. However, this is what you have to keep in mind. We're looking at a 10-year scope. So there's going to probably be other competitors. If there's any competitors, I know like they have to be the largest e-commerce like provider. If not, I'd be very surprised. But is 35% revenue growth sustainable over the next 10 years? I'm going to say no. And granted, that means 40 is out of the question. So that's why I like to stick with the numbers that I said earlier at 22. What was it? 22 and 24. Because at least if they beat these numbers, right, or if these showed up to be green, at least I know I have a proper margin of safety. Because let's say they do beat these numbers, right, then that my margin of safety would ultimately increase. So let's say hypothetically we did 28%, right, and we did 30 on the high side. Yeah, we're still not hitting those numbers. Like, we're getting close, but you know what I mean? You want to make sure you have those numbers in place. Now, granted, I could be completely wrong with these profit margins, but however, margin of safety, folks, that's the name of the game. We want to make sure that we're being as conservative as possible. And because, listen, when it comes to investing and any kind of just stock research, the upsides will always take care of themselves. You don't have to worry about a stock going up. What you have to worry about is the downside risk. And as something gets more cheaper, it gets less risky. However, you want to make sure that you're putting yourself in a position where, okay, what can possibly go wrong to make this company go to zero? Your job is to mitigate that risk. If it doesn't hit those things, right, then you're laughing. The company's going up. Hopefully that makes sense. But those are my thoughts on Shopify. You know what? I like the business. I'm glad that the price has been decreasing a lot. I'm sorry for whoever bought at the top, but listen, I'm trying to buy great businesses at a fair price, and it being at $700 right now, I would love it for it to be lower. However, the numbers just don't make sense. But those are my thoughts. If you're interested in obtaining this software here that you saw in front of me, if this is something that interests you, definitely send me a message. My email will be found in the description below, and we can try to hook something up. This is my own software that I've built. It's going to be an app, and this software here allows me to just screen stocks super quickly and try to get an estimate as quickly as possible. But as always, folks, you want to do your own due diligence. You have to do your own research, and remember, this is an entertainment channel. It's not for financial advice. And that's the video. I'll stop rambling and leave a comment down below. What are your thoughts on Shopify? I'll see you in the next video. Take it easy.